Okay, so for chapter 12, we're going to be discussing capital investment decisions and how time value money can be incorporated into those decisions. Okay, so the first objective, we are going to describe the importance of these capital investments and also the capital budgeting process. Okay, so the basic idea of capital budgeting is we're going to be looking at long-term investments. And if you look at this description, where they talk about it's the acquisition of assets. Again, these are going to be long-term assets that are used for, again, a long period of time, and typically it requires a large amount of money to be paid. So the things we're going to be looking at with capital budgeting is time and money, and particularly we're going to be looking at cash flows, cash coming in, cash coming out, and also using, we'll get into this a little bit later, looking at time value money and interest rates and how we can use that also to incorporate that into the capital budgeting process. But remember, this is very important stuff. This has long years, long impact on a company's financial status. And so this stuff is very important. It's used internally to make these types of decisions. And in the next couple slides, we're going to walk you through some of the different methods that are used to make these types of calculations. So here's 4 methods we'll be looking at. There's a couple others, but just to start with, we're going to look at what's called the payback period, the accounting rate of return, net present value method, and also the internal rate of return. We'll start with payback method initially, and then we'll work into the accounting rate of return. And these are nice because they're quick, they're easy to calculate, and it doesn't take a genius to figure out how to, come up with the numbers. When we get into the NPV, net present value, this is where we're going to be looking at time value money. Typically, it's longer periods of time, so we have to start to look at interest rates and how that affects the present value of money. But again, payback, accounting rate of return, again, because these are typically effective for shorter types of time periods. You don't have to worry a whole lot about time value money because they typically are more effective for short periods. But again, these are all effective methods that are going to help us make decisions on the capital budgeting process. So as we get into looking at capital budgeting, one thing we might want to note is the concept of, again, of cash basis versus the accrual basis. Now remember, most of this class has typically been non-accrual because we looked at a lot of stuff that's used internally and not for external purposes. But just to kind of refresh you, remember that generally accepted accounting principles, this is primarily what you would have focused on in financial accounting. And that's all that, when do you recognize expenses when they're incurred, not necessarily when paid. And the same thing with revenues. You earn revenue. You don't necessarily have to have the cash. So the thing that's kind of to note about that is capital budgeting focuses more on cash flows than accrual accounting. So we're not really looking at financial accounting here, but we're looking at just simply what are the actual cash flows. One of the methods, though, you'll find it's called the accounting rate of return. They actually do use some accrual-based numbers in their income, so that you could maybe say that could be a weakness of that particular method. But again, we'll talk about the strengths and weaknesses later on. But most of the other methods we're looking at typically are strictly cash flows, and we're not really taking into consideration generally accepted accounting principles. So when we're talking about cash inflows, this could be future cash coming in, future cash revenue. It could also be considered future savings because sometimes if a company replaces automation, they get new equipment, that this new equipment could actually save you money. So that could also be looked at as cash inflows. You can also look at possibly selling assets in the future. They call that residual value or salvage value. So for example, if you buy some equipment now, in 5 years, you might estimate that you might be able to sell it as well. So that could also be a cash inflow. So this is just one version, gives you some idea of how you might go about making capital budgeting decisions. Notice like step 1, for example, you would identify potential investments. Step 2 is to somehow come up with these net cash inflows. Step 3, then you kind of basically start to do your methods, do all your type of tools to start applying the cash inflows and the cash outflows. And then of course the last couple steps, I mean, there's no really official, this has to be in this order, but typically you make some critical thinking processes, you evaluate your decisions or your methods, and then finally you end up making the decision, and later on you can analyze and see how well that decision paid off for the company. Okay, so for objective 2, we're going to first start with the payback method and the accounting rate of return method, and to show you how you can use these to make capital investment decisions. Okay, the payback method, again, this is thought to be one of the quickest and easiest methods to do your calculation, but the basic simple idea is as you try to figure out how long it actually takes you to recover your initial cost of investment. And remember, your initial cost of investment, that's going to be considered a cash outflow because that's basically what you're paying up front. And then you're trying to figure out exactly how long does it take to get that money back. So the basic formula is you take how much you invest, you're going to divide by all your cash inflows, and that's going to give you a certain time period. So remember, the numerator, it would be considered your cash outflow. Your denominator is going to be projected cash inflows, and once you divide that, that'll again kind of give you an idea of the length of time. So if you look at this example, you've got Tierra Firma is considering investing $240,000. Guys, that'll be a cash outflow. They're going to buy some hardware and software to develop a business portal. It says that the company expects the portal to save $80,000 each year. So that's going to be considered cash inflows. You've got the cash outflows up here. So the basic formula is you would just take the 240,000, divide by the 80,000, and you would project a payback period of 3 years. All right, so now let's look at an illustration again from your textbook. This is exercise 1218A. We've got the Cato Products is considering acquiring a manufacturing plant. It says that the purchase price is $1,860,000. So if you stop right there, that's going to be your investment. So that's going to be a cash outflow. That's going to be a cost. It says that the owner believe that the plant will generate net cash inflows of $310,000 annually. And then here's their kind of like some of their decision criteria. It says it will have to be replaced in 5 years. It says to be profitable, the investment payback must occur before the investment's replacement date. So we've got something to kind of use as our constraint to determine if this would be a good investment. It says use the payback method to determine whether Cato Products should purchase the plant. So again, you've got your cash outflow, which is $1,860,000. You'll divide that by your inflows, which in this case is the same amount as 310. You're going to compare that payback period to see if you can recoup it within 5 years. Then that might be a reason to make the investment. So in this case, when you do take those inflows, the amount that you're investing, the outflows, and divide by those inflows, notice you get 6 years. 6 years. And if you need to have the payback before 5 years, this does not look like it would be a good investment. So the other issue with the payback method is the ones we've looked at so far, the cash inflows were equal. So sometimes you can also get payback method where you have unequal cash inflows. If you look at this illustration, notice that the initial investment is $240,000, and notice that the cash inflows, they give you 1 through 6, are all different, or at least they're not all the same. So again, you're trying to recoup this money. So anytime you get unequal cash inflows, you would need to set up a little spreadsheet schedule like this and basically just start to track your cash inflows. So you'll notice in year 1, they recouped $100,000. In year 2, that's another 80, so that brings you up to 180. Notice again, you're trying to get to 240. When you get to year 3, you'll note that now that's another 50,000. You add that to 180. Now you're up to 230. So now you only have another $10,000 to go to recoup your investment. And if you look at the next year, notice the next year you got $50,000 coming in. That's definitely going to happen in year 4. So what you'd have to do here is we know for sure it's going to take you 3 years. And at that point, you still have $10,000 left to recover. So what you do is you take that $10,000 and divide it over the $50,000 in year 4. And that would be that fraction of the year that you would tack on to 3, and that would then that's basically then how you'd calculate your approximate payback period. So like I just said, go back to the previous slide, but notice you get to that year 3, you had $10,000 left. You just take that 10,000 divide by year 4's 50,000, that equals 0.2. You add that to the 3 years, so you'd say your payback period is approximately 3.2 years. So if you look at this illustration, this is E1219A. This is going to be a payback method with unequal cash inflows. they give you that the initial investment is going to be a cost of $1,450,000, and then the rest of it gives you all the individual cash flows for the individual years. So again, what you'd want to do is you'd have your years, and then I'm just going to write a few of these up just to kind of give you a hint how this works. So you'd have, again, your cash in, and then you're going to have an accumulated total or column. So for example, in year one, it says that cash inflows are going to come in. It's going to be 305,000. Okay. And then it says in year two, it's going to be 290,000. And then it says, and 255,000 each year thereafter for 8 years. So then after that, it's going to be 255, 255, and so forth. I'll just kind of draw the line just so you get the point. So what you have to do is individually track and accumulate your cash inflows until you've actually recouped that $1,450,000. And as you can see, it's going to take you more than 3 or 4 years, but that's simply what you do. So in this particular problem, you're going to find that's right around year 5, year 6 is when you're going to start to get back that initial investment. And then you have to figure out, just a time frame. It's going to be a fraction of the year. In the next slide, I'll give you the exact numbers. So once you set up that little spreadsheet, what you'd find is that after 5 years, if you added all that up, your total amount that you received is right at $1,360,000. Notice now you have another $90,000 to go. In the next year, it's going to be $90,000 divided by 255 because that's the cash flow in year 6. That would equal right about 0.35. So you basically say your payback period, just add that to 5 years, is going to give you 5.35 years. So again, usually one of the biggest arguments against the payback period is typically you do not look at time value of money. But lots of times if you have a very, very short payback in terms of cash flows, that may not really be that big of a factor. But anytime you go out a few years, several years out, the time value of money can be a factor. So that's one of the big drawbacks for the payback method. And again, your basic decision rule about this, if you're just using the payback period, again, internally, you're going to have a time determined that you need to get this money back. And typically, the shorter, the better. But you'll compare whatever time you get to your internal decision criteria. Is 5 years good enough? Is 6 years good enough? And so forth. And then make that decision. Okay, so the accounting rate of return does use some accrual accounting concepts. And again, it's looking at operating income. Again, it's not really looking at specifically just net cash flow. So that could be a criticism of the accounting rate of return. The basic calculation is right here. You take the average annual operating income divided by your initial investment. Again, and one of the things about this numerator, notice what they do is they do take out depreciation, because if you remember, depreciation is that's a non-cash expense. But just because they take that one out, there could still be other accrual expenses into this income number, but depreciation can make up a big part of your expenses. But what you do again is you take, to get this accounting rate of return, you've got those average annual cash flows, but again, you're going to simply subtract out that depreciation expense, divide by your initial investment. Or we'll look at it a couple different ways. Or again, you take the average income from the asset that you're going to be investing, divide that by your initial investment, and then that'll give you your basic return. So for example, you remember doing the straight line depreciation method, you take the cost of the investment, subtract out the residual value, divide by the useful life. So for example, let's say you had annual depreciation of, let's say, 40,000. So one way you could do the accounting rate return, let's assume you had cash inflows of 60. What you would do is you would subtract out that depreciation of 40, divide by that initial investment, and this would give you what they call, again, your accounting rate of return. And then for the decision criteria for this one, you would compare this with some sort of other return that you have your set goal. If this return is too low, then of course you would not accept the project. So if you look at this example, to compute your average cash flows, notice they give you cash flows over several periods. This is over 6 years. That's a total of 360. If you just did an average, here's your $60,000. That's a simple average. Now, if you had the depreciation calculation, here's that number like we showed you how to calculate depreciation expense. So to get the accounting rate of return, you take that average cash inflow, subtract out the depreciation, divide by your initial investment, and that would be your accounting rate of return. So again, the decision criteria is once you get that ARR, you have some sort of internal required rate of return. And again, if the ARR, if it exceeds that, then of course you might want to say this would be a good investment. But of course, if that return is less than what you're desiring, then you'd say, of course, do not invest. All right, so let's look at an illustration from your book. So again, this is the same data from 19A. This is 20A, and again, you've got the investment cost, which is $1,450,000. It tells you that it's a 10-year life. They give you again the cash flows, and then of course this says that the investment has no residual value. And again, this is, we're going to be doing the accounting rate of return instead of payback period. So the next slide will show you a couple different ways to calculate it. Again, I'll show you the, just by looking at the cash flow average, and also we'll look at the other at the operating income formula as well. So again, what you do then is you take that average number that we just showed you, divide by your initial investment, and you get your 8.2%. Now, the other way you could do it is if you kind of go back and you've got depreciation. Your depreciation over the life of the asset was $1,450,000. If you divide that by 10, that's going to give you yearly depreciation of $145,000. I'm going to show you this method as well. And then your average cash flows, if you look at the total cash flows, it was $2,635,000. And again, if you divide that by 10, that's going to give you your annual cash flows average to be about $263,500. So I'm just going to write this right here. So that's going to be your cash flows. So then the other method that we've been showing you is what you could do then is you could also take the average cash flows, which is $263,500, subtract out that depreciation, which again yearly, so you'd subtract out $145,000, and then divide that by your initial investment of $1,450,000. That's another way to get to the 8.2%. Okay, so the next objective, we're going to talk about the concept of time value money and how you incorporate the time value money into the present and future value types of situations. The two basic ideas is we'll have what they call a lump sum payment versus an annuity type of payment. So factors to be considered again with time value money, and again you're going to be earning money over time, and the basic idea is that if you can get cash received quicker, the sooner the better, because remember you can take that money now and invest it into something else and actually earn more money for the future. So always remember, present or future value of money should always be more than present value money. So typically, again, the sooner the better is going to be the basic idea. So typically, again, when you're looking at time value money, you have what they call single lump sum type of payments, or you have what they call an annuity, which is typically what they call a series of equal payments. And that does make a difference in your calculations. You also have to take into consideration time period. That's going to be labeled as letter N, and also the interest rate that you're going to be using, or the prime rate or whatever interest rate they're giving you. That's all going to be factored into calculating your present value. So just some basic finance 101 types of issues. If you have what they call single or simple interest, simple interest, typically interest is only going to be calculated on the principal amount only. If you look at this illustration, for example, they give you 5 years of principal amounts, $10,000, and if you're earning 6% each year on just that same principal, notice that would be $600 per year for a total of $3,000. So again, in this case, the interest is calculated on the principal amount. This is called simple interest. So then when you look at the concept of what they call compound interest, this means that the interest that you earn each year is going to be added to the principal, and then that interest rate is going to be calculated on whatever that balance is, plus all the interest that's earned year to date. So again, if you look at the same illustration, notice year one you have $10,000. You have an interest rate of 6%. That's $600 for year one. You add that $600 back to the principal going into year two. Notice now your principal is $10,600. Multiply that by 6%. Notice how that gives you a different interest earnings. So again, you keep on adding on this interest to the principal and then calculating it times the interest rate. And again, that's called compound interest. So just some basic present value versus future value. So present value is today. So for example, if you had $10,000 today, 6 years from today, if you go back to the previous slide using those compound interest, is that initial investment would be worth about $13,380. So remember, this future value incorporates interest. The present value typically takes interest out of the equation in terms of what the actual amount is. So we're interested always in the present value, but remember, because we're always looking for future periods generating cash flows, lots of times what we're going to have to do is most of the problems you'll be given that future value idea, and what we're going to have to do is we're going to have to discount that future value back to today, and that's called present value. And again, the way we're going to do it is we're going to use what they call present value tables. That's going to give us the conversion numbers. That's going to take your cash flow future values and convert those into a present value number. So just to kind of summarize this, remember, if you invested money today, that money is going to grow. And that's going to, and if it's 5 years or 6 years from now, that's going to be called future value. So the two different types of tables you're going to be coming into contact with, I mean, there's more, but the ones we're going to be working with is typically what they call the present value of $1. That's your lump sum or one-time event, versus an annuity, which is going to be basically, they say 2 or more, but it's all going to be equal amounts, and each table will give you a factor. And again, you have to look at time period and interest to calculate your present value. So for example, if you're trying to determine what table to use, let's say that you will be getting $200,000 5 years from now. So that would be n is equal to 5. It says the interest rate you could earn is 5% or 6%. So that would be your interest rate. The question would be, what table would you want to go to? Well, that is a lump sum number because you're only going to be getting that one time. So you'd be using these factors in your table. You'd go to the present value of $1 table to convert that into a present value. So again, you'd have to find this, but it's table A in your book. Again, you'd use the present value of $1 using interest rate of 6%, 5 years. You'd find a factor that's 0.747. You take that factor, you're going to multiply it by the future value. So remember, this 200,000 represents future value. Once you multiply that using these numbers, you would get a present value, what it's worth today, which would be right around $149,400. So again, trying to determine which table you want to use, look at this example. It says you will be getting $1,000 for each 5 years. Interest is 4%. So n again is going to be equal to 5. Notice this is going to be an annuity because it's 2 or more, and it's going to be equal amounts. So you'd want to be going to your present value annuity table to convert these values into a present value. So again, remember $1,000 over the next 5 years. Notice once you go to this present value of annuity table, using interest rate of 4%, 5 years, here's your factor. You take that factor, multiply that by your future value of annuities. This tells you right now, today, how much that money is worth. That's called your present value of your annuity. So typically, at least for us, you'll most likely be using the tables. But you can use Excel. There's computers, calculators that can also do these calculations real nice and quickly for you as well. All right, so let's look at an illustration on time value money. We've got Tessa wants to take the next 6 years. So I'm going to write up here n is equal to 6 years off work to travel around the world. So she estimates her annual cash needs to be $31,000. If she needs more, she'll work odd jobs. Tessa believes she can invest her savings at 12% until she depletes her funds. Requirements are, number one, how much money would she need now to fund her travels? And then part 2, it says after checking with the bank, she learned that the amount of interest is only going to be 8% versus the 12%. Okay, so think about, so $31,000, we got n is equal to 6, so we're going to have a couple different interest rates. We're going to have to go to our table. Now, remember, so this 31,000 is going to be considered a future value, and we'll convert this into a present value. And on the next slide, we'll show you the table numbers that you would need to do that. So just to kind of remind you of the data in the problem, it's 6 years, n is equal to 6. And then for requirement 1, we're going to be using an interest rate of 12%. This is an annuity because she needs $31,000 per year for the next 6 years. Once you use these factors in your table, you'd get 4.1114 multiplied by this future value. Remember, the 31,000 would represent a future value. You would get a present value of your annuities worth 127,453. And then on requirement 2, you're still using n is equal to 6. Your interest rate is now at 8%. That's going to change your table factor. Notice you just look it up, you get a different factor. And again, multiply that by your future value number of 31,000. That's your annuity. That converts that into a present value of 143,310. Notice she needs more money now if the interest rate goes down because you're not earning as much. All right, let's look at this illustration again on time value money. It says that you just won the state lotto. The state lottery offers you the following payout options. So number 1, 13.5 million 5 years from now. That would be simply that's your lump sum type of deal. Part 2 gives you 2 million at the end of each year for the next 6 years. That's going to be an annuity type of situation. And then option 3, again, 4 years from now, you get 12.5 million. Again, that's going to be your lump sum calculation. So assuming you can earn 10%, which option would you prefer? So go to your tables. Remember, option 1, you'd be using n is equal to 5. All the interest rates are at 10%. You'd go to your $1 table to convert this number to see how much that's worth right now. So remember, these are all future values. Option 2, notice this is going to be n is equal to 6, and you're going to be going to your annuity table. And then option 3, it's going to be n is equal to 4. Again, you're back to your lump sum table. Do your present value conversions, see which one is worth more. Now that would be the option that you would want. So option number 1, notice once you go to this $1 table, you find your table factor. That's worth today $8,382,000. Option 2 is an annuity. You go to your table factor at 6 years, 10%. Notice that's going to be worth today $8,710,000. And then option 3, which is your other lump sum payment, so go to your present value of $1. Notice your table factor multiplied by that future value, so that amount is worth $8,537,000. So if you look at these 3 options, whichever one is worth the most is the one you'd want to go with. In this case, it's pretty clear you'd want to take the annuity. All right, so for the next objective, we're going to use this concept of time value money. Typically, that's called the discounted cash flow methods, which uses time value money, again, to make the capital investment decisions. So again, the nice thing about the discounted cash flow methods is it does incorporate time value money. That is thought to be an advantage or a good thing. The 2 methods we're going to look at is called NPV, which is called the net present value method. All that does is it compares your present value of cash outflows to your present value of cash inflows, and of course you want to get a positive number to accept. The internal rate of return again is going to be more of a trial and error type of method, but again we are incorporating time value money, so these methods are thought to be a little bit better than the payback period types of methods. So the discount rate we're going to be using, all problems will give you the rate. It's some sort of what they call a required minimum rate of return. Again, some sort of return you want to get back on your investment. And of course, the decision criteria, as long as that NPV is positive, so greater than or equal to 0, you typically say the project would be acceptable. So if you look at this particular illustration, so let's say the initial investment is going to be $1 million. So guys, basically I'm going to put a negative in front of that because that represents a cash outflow. So assuming that you have annuity of inflows, so if they tell you in the problem, you've got cash inflows coming in annually at this amount. In this case, it looks like it's for 5 years using an interest rate of 14%. You can convert these cash inflows, these future cash inflows, into a present value inflow by using this table factor. So you'd get, in this case, you get 1,048,610. So what you do is you subtract out the initial investment. In this case, notice it is a positive number. This is greater than or equal to 0. So in this case, this might be an acceptable project because you have at least a positive NPV. No, you don't have to do any calculation on the initial investment because that is day 0. That is your present value. The only number you're going to have to convert is these future values in future periods, and you're going to have to convert those to the present value. And so again, the basic idea is if NPV is greater than or equal to 0, which means it's positive, you typically say it's acceptable. If it's negative, definitely you do not want to invest. All right, so let's look at exercise 1227A. It says use the NPV method to determine whether they should invest. So we've got project A, project B, and so notice we've got project A costs $290. That's your initial investment. It says and offers 7, so that's N is equal to 7 annual cash inflows of 63,000. They have a return here of 14%. So this is going to be an annuity. Project B, we've got 395,000 as your initial cost. Notice it's 10 annual cash inflows. Again, that's another annuity, but on this one you're going to be using N is equal to 10 and an interest rate of 10% on project B. So again, to get the NPV for each project, again, you've got your initial cost, so your initial cash outflow. Okay, so for example, for project A, your year one, I'm going to put a minus in front of that. That's a negative 290. That's a cash outflow. So then for your cash inflows, what you do is you take that 63,000 and you're multiplying that by your table factor. Okay, so the 63,000 times your table factor using N is equal to 7. Interest rate is equal to 14%. Again, this is an annuity. That's going to give you an amount, and you're hoping that that amount is more than 290. The same thing for project B. You've got your initial cost, which is your initial cash outflow. I'm going to put a minus in front of that. That's a negative 395,000. And then to project your cash inflows, you'd have 71,000 times your table factor. Your table factor in that case will be N is equal to 10. Interest rate is equal to 10%. And again, once you get that number, hopefully it's a positive number. Hopefully you want it to be more than the 395. And then to compare the two projects, obviously whichever one has a higher NPV is the one that's going to be the one you want to accept. So again, if you look at project A, note you take these cash inflows, you go to your annuity table, here's your factor, you multiply that out, that's your present value. Notice your initial cost is more. This is a negative, so right away this is not positive number because you want to be greater than or equal to 0. This is not, so you know right away project A is not going to be acceptable. Project B, again, you take the cash inflows. Here's your table factor. You multiply, again, 71,000 multiplied by that table factor. That gives you this. Notice the initial cost investment. That gives you a positive cash flow, which is greater than or equal to 0. So this would be the one you would want to accept. So sometimes you do get cash flows that are unequal. And in that case, if you do get that, you're going to have to apply the present value to each cash flow individually. Now, again, if you're doing this manually, it might take you a little bit more time, but remember, computer spreadsheets can handle all this actually pretty quickly as well. So you note in this case, if you had unequal cash flows, notice this is over 5 years. Notice you'd have to go to your present value of $1 table and individually convert each of these one by one. Okay, so it may seem like an inconvenient, but if you had a spreadsheet set up, a spreadsheet could still do this pretty quickly. But the basic idea of NPV is still the same. You still want your present value of inflows to be more than your cash outflows. But again, if it's unequal, you're gonna have to go back to your present value of $1 table and discount those individually before you can determine the NPV. So if we look at illustration, this is exercise 1229A. We've got the current industries deciding whether to automate one phase of its production process. It says that the manufacturing equipment has a 6-year life, so I'm going to write out N is equal to 6. It's going to have a cost of $925,000. So remember, that's going to be your cash investment. That's going to be your outflow. And then notice here's your cash inflows. These are basically unequal. And if you had to calculate the net present value using 16% as your interest rate, again, you're going to have to discount each one of these individually because they're unequal. You go to your present value of $1 table, and then you're going to discount those just like you're doing it like a $1 table, and then add those up. That'll be your net. That'll be your total present values, and then you want that number again to be more than that initial cash outflow. If it is, if it's positive, then the project could be acceptable. And then in part 2, what they do is they say, what if you're going to refurbish this equipment at the end of 6 years? So that's going to be another cash flow that could take place in year 6 if you decide to go with that option. And then it also tells you that the refurbished equipment could be used one more year, providing $75,000. So again, I'm just going to do this first part. I'll show you the second part in the textbook illustrations just to kind of give you a handle on this unequal cash flows. But sometimes what happens is that you may have other types of options to do some refurbishments and so forth, which does change the cash flow for each period. You still have to discount those back to day one. So note again, you've got your initial cash investment of $925,000. Here's your individual 6 years. Notice they call these lump sum because they're unequal. You go to your table factor, which are right here. You can find these in your tables. You're going to multiply each of these lump sums individually. You'd add all these up, and note in this case you have a negative net present value. So this thing would be a no-go as is, because you want your net present value to be at least 0 or more. Now, another useful tool when you're doing these discounted methods is called the profitability index, and this also helps you give a relative comparison, because remember, some projects cost significantly more amounts in upfront cash. So typically what this is going to do is it's going to give you a return for every dollar invested. So the profitability index is a good measure in terms of using time value money to make decisions on your capital investments. So the basic calculation is what you do to get the profitability index. If you look at this formula right up here, you take your present value of inflows and you divide by your initial investment. And so in this case, they gave you 3 scenarios of present value of cash inflows divided by the initial investment. And notice they give you the profitability index. Relative, if you look at the cost of each investment, relatively speaking, if you had to choose between these 3 projects, you'd want to go with the one that gives you the most return per dollar, and that would be project C. So let's look at an illustration. We've got exercise 1231A. It says they've given you these 3 capital investment proposals. You've got equipment A, B, and C. They've already done the calculation, so we just want to show you how this index would work. So for example, you've got your present value of cash inflows and your initial investments, and they also have the net present value. So if you just looked at these right now, you'd probably say let's go with equipment C because it has the highest net present value. But if you incorporate the profitability index, which again is where you take that present value of cash inflows and you're going to divide by your initial investment, let's see if that might change your decision in terms of which project you should accept. So notice in this case, again, you take the present value of your inflows, divide by your investment. This is going to give you your index. And for each of these, once you did that, notice it looks like, in this case, project C or equipment C would still be the best because it still gives you the best return per dollar of investment. All right, now the internal rate of return will be the last one we're going to look at in terms of tools. What this basically does is this is the interest rate that's going to give you a net present value that's going to be equal to 0. So remember, the decision criteria for net present value is you always want to be greater than or equal to 0. The internal rate of return is the internal rate that's going to give you that amount. So that's one way to look at it, but it's basically, again, the same basic idea. It's how much money, how much return the company is going to be expecting. But this one's called internal rate of return, but I like to look at it. It's also going to be the rate that's going to give you that NPV that's going to be equal to 0. And typically, sometimes when you're doing internal rate of return, you may have to do some trial and error, specifically if your cash flows are unequal. So if you look at this one, for example, let's say that you're going to have equal cash flows. And again, you want to get the rate that's going to give you net present value equal to 0, which basically means the rate at which your present value of cash inflows equals your cash outflow. And so the basic idea is you're going to have to go to your tables. You take that initial investment. You're going to divide by those annual cash flows. Again, assuming they're equal cash flows, you can go to your table, and that should be able, basically, it's going to give you some sort of number here. Once you do this calculation, you go to your tables, and that should, approximate the rate that would give you, it's called your internal rate of return. And like I said earlier, typically, if you have unequal cash flows, it could just be a trial and error type of process, as you're just going to have to guess a little bit until you get it right. So then it comes down to, how do you use the internal rate of return? And again, you have internally what's called your required rate of return. And if that IRR is more than that or it meets that, you'd say invest. If that internal rate of return does not meet your, required rate, you'd say, of course, do not invest. All right, so as we look at 1228A, we've already looked at this one for the net present value method, but they want you to calculate the internal rate of return. And so for project A, you note that the cost is $290. It's going to be 7 years of annual payments at an interest rate of 14%. For project B, again, there's your initial cost. That's going to be N is equal to 10. Interest rate is 10%. So what you'll do for each of these is you'll take the cost of your investment. I'm going to write this right here, and you're going to divide that by your cash flows. Okay, so take the cost of the investment, divide by these cash flows. That's going to give you some sort of table factor number that you're going to try to use. For project A, you'll look for where N is equal to 7. You're going to try to locate this factor. For project B, again, you'll use N is equal to 10, try to locate that factor, and then whatever interest rate it is, that's going to be the internal rate of return. So again, if you look at project A, 290,000, annual inflows is 63,000. The 14% is the required rate. So what you'd have to do is to get the internal rate of return, take this cost, divide by the cash flows. You're basically looking up, trying to find this number in your table. So you'd be looking where N is equal to 7. You would find that this number falls somewhere between 10 and 12%. For now, you're just going to say that's my estimate. And of course, because that is less than this 14%, you'd say this one looks like it's a no-go. For project B, again, same thing. You take your initial cost, divide by your cash outflows. This is your table factor. And again, using N is equal to 10, you're looking for this number. And notice this one's going to be between 12 and 14%. Because your required rate of return is 10%, because this number is at least more than your required rate of return, you'd say that this project might be acceptable. Okay, the last objective we're going to look at is just again to talk about these methods, what's good about them, and in some cases what is bad about them as well. So to recap, remember the payback period. Remember it's real simple to calculate. It's not a lot of math involved. You just have to do some division. The big drawback, the big disadvantage is that it does, for a couple things, it ignores cash flows after the payback period. It only looks at cash flows during this payback period. It doesn't look at cash flows other than that. And then the other thing is it does ignore time value money. So that is a disadvantage. The thing about the accounting rate of return, it is the only method that we've been looking at that does incorporate accrual accounting. And again, the nice thing about it is it does look at operating income, and it does help measure, show you the profitability. So that's another method that the other ones don't do. They just look at cash flows. This one does incorporate profitability into the decision. But again, the bad thing is it does, again, ignore time value of money. Okay, net present value method, the big thing, the nice thing about this one is it does incorporate time value of money, and you're looking at return. It's giving you some sort of comparison in terms of what you want to earn, what should you be earning. Sometimes though, depending on the size of the investments, it can be difficult to compare. And remember, you are making projections out several years in advance. And so sometimes that's also difficult to do as well. So you are taking some risk in some of your assumptions. But you can also use this thing called the profitability index. Can give you a little bit better way to do some rational relative comparison, apples to apples, so to speak. But again, you're looking so many years out, sometimes it's difficult to come up with the exact number in terms of these different types of amounts to compare. Okay, internal rate of return, again, very good. It's probably next to the net present value method in terms of methods you might want to do because it does incorporate time value money. The bad thing is that, again, it assumes that all cash inflows are reinvested at a rate equal to the internal rate of return. So again, that's not always something that's valid. So that's one of the drawbacks to the internal rate of return.